The International Monetary Fund is yet again urging the West African giants to eliminate the remaining currency exchange restrictions and increase exchange rate flexibility. In its latest regional report entitled Restarting the Growth Engine, the fund says these policies are inflicting serious damage on an economy that is still struggling to adjust to the realities of sustained lower commodity prices. Our Washington correspondent Daniel Ryntjes has been speaking to the IMF's Africa Director, Abebe Aemro Selassie.
Nigeria has been basically hit by, really a very severe shock with the collapse in oil prices. And of course, oil contributes a big part of fiscal revenues and also, of course, a big chunk of the country's foreign exchange earnings. And the shock is really quite huge from several years, many years of oil prices at around 100 now to 50. So that's a big cut in real income. The exchange rate has been allowed to move from where it was, of course, a couple of years ago. Not quite fully to what the parallel market rates would suggest, but that is also a very thin market and shouldn't just be seen as the benchmark. On the fiscal side, there's been a big loss in revenue, and that needs to be made up for. Now, the good thing for Nigeria is that they have the debt level is fairly low. So I think it's of the order of about 15% of GDP. New sources of revenue have to be found. As you know, the country has tremendous development spending needs in infrastructure, health, education. So a new source of new revenue streams have to be found to pay for those. So, some kind of a framework to get the tax to GDP ratio, which is only 7 percentage points, up to, the 14–15% that it needs to be, has to be found. And, this is not going to be done in 1 year, but over the medium term. But those steps have to be taken now. On the exchange rate side, creating a market where supply and demand can clear in a very transparent way, that the mechanism for allocating exchange rates goes back to something which is, both the rate reflects market conditions, but also there's a mechanism which is transparent as what's needed. They are edging towards that, but more action is needed. And that, of course, needs to be supported by complementary monetary policy.
What does policy uncertainties mean in the real world?
In the real world, basically, if you're a private investor and you don't know what the path for tax rates is going to be like, if you don't know whether public investment that's needed to alleviate energy constraints are going to actually be taking place. People need long horizons to plan and to do investment, and so that holds back whether your decision to invest. In some cases, exchange rates are not fully aligned, or access to foreign exchange is not readily available. That also, of course, impacts your decision on whether to invest or not.